There is a live look at the CPI story in the latest February inflation reading. So inflation coming in hotter than expected. At the same time, a new report from TD is suggesting that we could see a shallow recession in the cards for Canada. Let's bring in James Orlando, who's Director of Economics at TD, to talk a little bit more about what is certainly a balancing act for Canada and for our central bank. James, let's start with the inflation numbers today and your reaction to those.
Yeah, thank you very much. It's clearly a situation where inflation started coming back. Everyone knew that inflation was going to rise just based on the fact that you had the GST, HST holiday coming off in mid-April. This is something that's going to continue into March because we only had half a month where the inflation data were impacted based on the GST, HST impact. The issue is that for us is how much is this going to continue? Not just into March, but into April, into May. We have a situation where it's not just the tax impact, the tax holiday that's pushing up inflation right now. When you look at inflation excluding taxes, excluding indirect taxes, which is what this is here, we're looking at inflation moving potentially above 3% by next month. Now, these are pretty big impacts right now, and it kind of reminds us of what inflation was before. We had a nice time period where inflation was fairly stable, and now inflation appears to be coming back, and this is even before the impact of tariffs on the country.
So obviously watching the pricing worries, but as I alluded to, this idea of a shallow recession that TD is talking about today is getting some attention. So also growth concerns.
Absolutely. I think if we took tariffs out of the equation, Canada was actually regaining its strength. You look at the Canadian consumer, Canadian businesses, you look at inflation, they were all starting to come back in a way such that the Bank of Canada was likely going to have to pause rate cuts. But then you layer on tariffs. And when we look at tariffs, it is very much a scenario-based world we live in. What's the size of tariffs? How long are they going to last for? So when we do tariffs that are potentially on again, potentially off again for a 6-month period, we're looking at what we calculate is we are going to hit what is a technical recession in Canada. So 2 straight quarters of negative growth. Now, these aren't big negative numbers, but they are negative. So I think this reflects Canadian consumers and businesses with their confidence being hit based on these tariffs. So that is the big story, and that's the way we're communicating to our clients.
So I've asked the question around stagflation today in light of the inflation concerns and the struggles on growth. How much of is that a scenario that you think is fair to characterize for Canada right now? And B, how much of it ultimately depends on whether tariff threats, I mean, obviously we've already seen a trade war start, but if threats for more tariffs become a reality?
I think the significance of tariffs is big here. So right now in Canada, we have strong economic growth, but inflation moving slightly higher. That's not stagflation. What we're worried about is having a rapidly rising unemployment rate with even higher inflation. And in a tariff world, I think this is the risk that we're looking at, where growth gets hit based on consumers and businesses pulling back on that confidence shock. And at the same time, inflation rising on just the mathematics of tariffs. So this is a challenging world even for a central bank to be working in right now. And I think when we look at stagflation, obviously people think back to like the 1970s, 1980s time period of very high inflation, double-digit inflation with a rapidly rising unemployment rate. This is a much smaller, not as in magnitude, not nearly as severe as what we're talking about back then. And all this depends on the on again, off again of tariffs. If these persist, this is the outcome that we'd be looking at. If there's an agreement that it's reached, if we're able to get tariffs to come off in a very rapid way, that would be something where the Canadian economy would likely regain some of its strength, maybe not all of it, because there is that confidence shock. And also there would be less upside for inflation in that world.
James, I know just as your team is trying to predict where we go, another consideration is Canada's fiscal response. Can you give us a sense on how much money the Canadian government you think would be ready to throw at this period of uncertainty and where that money would go?
Yeah, so the government has given us indications already. There's already been some efforts, for example, Export Development Canada, to provide support for businesses. The way we calculated in this, in our scenarios that we published today, is that 1% of GDP is spent by the government. So that's over $20 billion extra spending for the government to support consumers and businesses during this difficult time. And that is close to what we've seen in history, where you have a big drop in output, drop in spending, and the government tries to cushion some of that. They can't cushion everything, though. I think that's the issue that we face as a country right now, is that we have a risk, we have a shock that's potentially going to impact our country in a severe way. And what can fiscal and monetary policy do to cushion this blow? And what our forecast shows is they can't completely cushion it. We can't protect Canadians and businesses completely, but what we'll do is we'll cushion them somewhat. So what we have here is 1% of GDP is helped by government spending.
1% of GDP. The other thing, I suppose in the short term it might be more intangible, but as time passes, we'll just see it potentially show up in numbers. Is let's say we get to April, everybody is fearing the worst. Let's say there's some political games again, and a little bit of delay on additional tariff action. What can we say about the impact to Canada's economy just by continuing to push out the uncertainty? Like, are you already seeing, at least in some data sets, the impact of the uncertainty regardless of tariffs?
I think we are to some extent. It's very nuanced, though, and we're really trying to find the data points that would agree with that story that you're telling right there. For example, like the real estate market in Canada really weakened in the last month. How much does this have to do with weather? How much does it have to do with people being uncertain about committing to such a big purchase during this time of uncertainty? Business sentiment is very weak right now. Consumer sentiment, based on the Bank of Canada's own surveys, is falling down a cliff right now. And I think this is something that should play through. If you talk to any economist, they will say that when businesses and consumers lose their confidence, they spend and invest less. So even if we go into this on again, off again time period of tariffs, how much does that hit people's confidence and business confidence such that they actually follow through with pulling back their spending behaviors, even without tariffs actually being implemented? And I think this is something that we worry about, that there will be some level of scarring, even if there is a delay in April once again.
Okay.